morning, everyone, and a very warm welcome to those who have joined us online during this Minds and Money 2020 virtual conference. My name is Jos Simson, and I am the CEO of Tavistock. It is a pleasure to chair today's ESG focused panel, in which we will examine how the industry and its constituents can maintain its momentum behind ESG and win over critical groups such as governments, communities, and generalist investors alike. Not a week goes by without a large international investor showing the importance of ESG in their investments, be it the removal of fossil fuels in their mandate or the creation of new ESG dedicated funds. In October, we saw an open letter by a group of high-profile global investors representing more than 10 trillion in assets, right to the boards of some of the world's top mining companies, asking them to justify their social license to work with Indigenous communities. Earlier in November, Scottish Widows announced it would dump £440 million of company holdings that fail ESG tests, specifically companies with 10% of their revenue from fossil fuels or those below the UN standards. And indeed, hot off the press, a recent open letter by global investors representing another 9 trillion in assets wrote to 36 of Europe's largest companies to ensure the Paris Agreement is factored into financial reporting with 5 clear steps investors expect companies to take in preparing Paris-aligned company accounts. Of those signatories, 2 are represented on our panel today. It is against this backdrop that I'm extremely pleased to welcome such a high caliber team of panelists from across the universe of investors. Today, we are joined by Adam Matthews. Adam is Director of Ethics and Engagement for the Church of England Pensions Fund, as well as co-chair of the Transition Pathway Initiative and also a board member of the Institutional Investor Group on Climate Change. Alongside Adam, we have Amanda van Dyke. Amanda is Managing Director and Head of Sustainable Resources Strategy at Arch Emerging Market Partners, a specialist emerging markets investment advisor. From the London Stock Exchange, we are joined by Adrian Rimmer. Adrian is a Senior Advisor, Green Finance. He is currently leading a program to scale up sustainable finance and ESG disclosure across the LSE, which to date has established a green economy classification across its markets, as well as an ESG disclosure benchmarking tool for companies. And finally, to complete our list of panelists, we have Andy Jones, Lead Engager in Europe for Federated Hermes. Andy's team proactively engage with over 400 companies across the globe on their ESG disclosures on behalf of their pension fund clients. Thank you, ladies and gentlemen, for joining us. So, Andy, if I may, I'd like to come to you first with our first question in relation to a report by Saracen, which found that 6,000 companies had audited. Very few are on track to meet the Paris Accord. The report claimed that there is a disconnect between all of the climate pledges investors are making and what corporates are doing. How do you think this relates to the mining sector? Do you think the disconnect exists with this group more than others?
Thanks, Jos, and a very interesting question. I say first of all that it doesn't particularly surprise me. I think we are concerned by a lack of alignment to Paris and a Paris pathway in a lot of sectors, including to some extent in mining. I think what we have seen over the last 12 months, 24 months in particular, is a real focus by many companies, including in the mining sector, to set out an ambition aligned to Paris. This doesn't mean that they are aligned, it means they want to get on a pathway towards being aligned to Paris. So really what we've seen is a lot of thinking being done, a lot of resources being put in place to setting targets and thinking about what a pathway to low carbon really looks like. But now, the question now really turns to implementation of those pledges and those ambitions. But I think the story is probably a bit more, to it than that. I think we have seen in the sector, to its credit, a lot of thinking going back many years with regard to efficiency of operations and how to decarbonise the energy use, for example, in particular. And I think that this is really, for many companies, an evolution or a further step on that pathway. For others, there's more to do, but for many, there's a lot of good thinking already being done. There's a lot of piloting of new projects and new technologies, which is great to see, which I think will really support this implementation. So I guess from our perspective, what are we looking for? We're looking for obviously emissions reduction, but I think in the short term, it's really key for us to see and understand how capital is deployed within companies to understand that they are aligning to the transition. But I think what I found through conversations with companies in the sector, And with this quick question around, are they aligning to Paris? I think many still see it quite difficult to make a Paris pathway their base case for planning. And I think this is where we're trying to get to at the moment in our engagements and conversations, to really give them confidence and understand how they can align and transition to that pathway and be on that pathway towards a net zero goal by 2050 or earlier.
Thank you, Andy. Amanda, if I could ask you the same question in terms of your dialogue with miners, particularly around that pathway.
No, yeah. I do think, look, I think every miner in the world, from junior all the way up to, you know, the really big ones, realize that ESG is here to stay and is not going away, and investor requirements are, from an ESG perspective, are just going to get bigger, not smaller. The problem for the big established miners is that it's very, very difficult to greenwash. It's very, very difficult to retroactive. So we have billions of dollars of installations here that were built often many years ago, before ESG was a phrase anyone even knew how to use. And finding a way to lower your emissions when you've got, you know, 2 billion of infrastructure based on coal, shall we say, is very difficult. I think that nobody in the mining sector doesn't know that they have to change things. I think that figuring out what ESG means and figuring out how to do it and figuring out how to get on that pathway is something that they're all trying very, very hard to do. But it means changing, you know, 100 years of practices in an industry and arguably $1 trillion of infrastructure that exists in the mining world. And I think they're trying hard, but it will take time. And in some cases, frankly, it won't be possible. Like, there are some things that just can't be made green. They would just have to be rebuilt. The newer miners, the ones who have come on later, have a better chance because they can build it to the right standard to begin with. But I think everyone knows, everyone wants to. It's just figuring out how, and how they can do it in a cost-effective manner without tearing down everything they've got and starting from scratch.
Thanks, Amanda. And just on that point of how far miners have come, I might come to Adam, if I may. Adam, we're seeing a whole raft of open letters from investors. I mean, in your dialogue, or your own opinion, do you think miners are doing enough to lead the ESG agenda, or are they actually having to react to investor sentiment?
I think there's an element of reaction. There's clearly good practice in the sector, particularly within some companies, and there's been other companies that have demonstrated good practice and then have come a cropper. For example, Rio over the Yunnan Gorge. I mean, many would have assumed, based on ESG indicators, that they're very much at the forefront of dealing with those issues, in particular the importance related to Indigenous communities. And yet we find a situation that when you look at it, really represents very serious concerns that go far beyond the individual issue itself. And therefore it calls into question, what is it we've been having disclosed to us, and what is it that we think we understand as investors? And so I think that there's a series of issues across the mining sector, be it on climate change, be it on relationships with Indigenous communities, be it on tailings dams or automation, where investors are increasingly looking at the issues as sector-wide concerns, where we need to have very clear assurance that there's an understanding of the issue, the risk, and that really investors are going to determine what are the criteria of whether a company is addressing that issue in an effective way, and by doing so, having a social license to operate within its jurisdiction. And so you're going to see further interventions from investors in the way that you have this week and the way you saw a few weeks ago. And I think you'll see a consolidation of the expectations over a period of time. I'm very conscious that companies have had a sort of blizzard of requests from many directions, and there does need to be a consolidation within the sector, and I think that will happen. But I think it'll be driven by asset owners in particular at the top of the investment chain, and I think it will be developed very much with input and partnership in mind with companies, but to get to a point where there's independence at the heart, because we need independent assurance that these issues are being addressed well by companies, understood well, and then that in turn will inform the way that we can invest. We can be shareholders, we can be bondholders in the sector. Ultimately, we want this sector to flourish and succeed. It's hugely important, and we can't allow it to be undermined by incidents such as has happened recently.
Yeah, absolutely. And we saw that incident see a parting of ways with its CEO. So investors spoke with their feet. So, and thank you. I'll come back to that framework and benchmarking and disclosure point shortly. Adrian, can I come to you if that's all right, in terms of your experience and how you're seeing that dialogue and dynamic between investors and miners?
Thanks. Yes, I think we see both extremes of it. From the dialogue we have with our issuers, we engage particularly over this summer, really getting a feel for what the level of understanding among issuers of all types, including the mining sector, was around climate change and how we could help them. And we saw both extremes. So we've seen the largest, more sophisticated organisations who are very actively engaged with their investors and with the schemes for disclosing, in order to make sure that they're sharing the right sort of information. But also there's the other extreme, which is really still a very much a lack of awareness among miners around what investors are looking for. And so, it was interesting to see how distinct those two groups were. So there's a lot of work that still needs to be done to really improve dialogue between investors and issuers. And as Adam says, understanding what disclosure is required and what that means in terms of how the business operates. Because I think a lot of organizations, particularly when they start this journey, they still see it as a box ticking exercise and not one that's about how do you run your business and how do you share information about how you're running your business. So one of the things that we put in place last year was really to help issuers who are sort of on that early stage of the journey to understand what investors see as the most material disclosure metrics that are required in their sector, and to point them specifically at the relevant standards, so GRI and SASB and CDP, and say, these are the key things you should be disclosing. It's a starting point, not an end point. And this is the data we see you disclosing, and this is the gap between the total amount that sort of would meet that sort of key set of metrics and where you are now and where your peer group is. So those are the sorts of things that we really want to see more of, and we're going to be building on that, particularly in relation to climate. And I think that what we'll see with the announcement by the FCA on mandating TCFD disclosures is really going to drive that further.
Yeah, it does provide a clear level of disclosure of what investors are requiring, particularly on that E of those ESGs. Thanks, Adrian. Andy, do you think
pick up on that on a point being made, which I think is quite interesting, around your previous question around whether companies being forced to change by investors. And I think both Adrian and Adam have touched on this point, which is quite interesting, which is not just about being forced to change. And I think it is often a partnership between companies and investors. I mean, I think when it works well, it's support for change, it's encouragement to change, it's kind of giving input and adding value to allow that change to happen and being there. Occasionally it does need to be forced, and there is a role absolutely for investors to take that position and force to change when needed. But it's much more than that. And I think, to Adrian's point, I think that's why disclosure is so important, because I think ultimately the investment industry just wants to understand. They just want to see what companies are doing, what the risks are, what the impacts are, and how those are being managed. And that's why we can get to the topic of what disclosure is best, but anything which talks to the kind of most material risks and the strategy and approach to managing those, which is based on risk and based on impact, is most useful for us to understand in what we do engaging with companies. Just again, I think it's all about kind of those relationships between companies and their investors, and that's certainly, I think, evolving over time.
I think it's worth just acknowledging that at the other end of it, we ourselves as pension funds are increasingly operating under an environment where we are having expectations placed upon us by the pensions regulator, by government, and the clear intention that we have to align to the goals of the Paris Agreement. Obviously, as a fund ourselves, we've already made that commitment, but you're seeing in regulation that commitment flow through to us as funds by the regulator, and then in turn demonstrating to our beneficiaries, to our trustees, that we have a plan, a strategy that shows that we're aligned within individual asset classes. So when it comes to companies in which we have shareholdings or bonds, we need to demonstrate that we've understood climate risk ourselves in the context of those companies, those sectors we're invested in, and how we plan over the next 5, 10, 30 years to be resilient as a fund. So we have a pressure on us as a fund at that level, and that's flowing through increasingly. So the point of partnership is key. We're all in this, in a sense, together. We all need to work towards the societal objectives of Paris, and we need to find the way to do that in the most cost-effective way.
If I could just jump in for a minute. I come from a slightly different perspective from most of you because I'm in the private equity space. And while we're investors, and we're investors with a major ESG focus across all our funds, we have a longer term relationship and a much closer relationships with our investee companies. And my experience with the more junior companies that I look at, looking to develop into production, is that there is confusion. These guys are miners, right? They've spent their whole lives in geology and engineering and building mines in what they think is the most efficient way possible. And they have new expectations being put on them. And I find that when you offer them investment that actually comes with a pathway, with an explanation, with a route to how to actually effectively implement ESG into all parts of your operations, they'll almost bite your hand off for it. Because it's not that they don't want to do it properly. It's trying to figure out how. It's not what they've done. It's not how they've been trained. One of the first bits of sort of caveats that we put into these companies is that we generally like them to hire someone who has a responsibility that reports directly to the board for ESG within the company, who looks at all of it and who does their ESG reporting for them. Because it's not the average miner who's incredibly good at his job, who knows how to do his specific job within the industry, doesn't know how to do this yet. And so they need someone in the company, the same way they need a COO and an exploration geologist and a CFO. They also need, I don't know if it's C-suite, but I'm starting to think it might be in the future, but they need someone at a senior level that reports into the board at ESG across the company. And that bridges that gap between investor expectations, or they're not even investor, they're just global expectations, and how to practically implement them all the way down to the ground. As I said, though, the more difficult part is trying to retroactively change both the social contracts that existing large miners have and adapt their existing operations, because that is a bit of a harder challenge. But I think my personal experience with the industry, both from the junior level and the senior level, is they all want to do it. They're just trying to figure out how, because it's just not how any of them have been trained.
That's fantastic. Thanks, Amanda. So Amanda talked to a potential skill set deficiency. Andy, if I can come to you, in terms of the other headwinds miners are facing to adapt to this ESG requirement, you mentioned it's disclosure of risk, increased disclosure of financial reporting. What other headwinds are you seeing in this sector for miners to sufficiently engage and provide comfort that they are leading the charge on this ESG disclosure front?
Well, I think one of the biggest trends in the sector, and one that we're quite interested in, is what's happening down the chain. And I think in the investment industry, there's a lot of increasing interest around what's happening down the chain. So talking about kind of the move to renewables, move to electric vehicles, and a broader just acknowledgement and interest by customers down the chain to think about responsibility and where these products come from. And this is interesting, I think, because ultimately we want to see mining companies who are future-proofed because based on where they're located, based on the products they provide, but also the way they do their operations. And I think that's a big interest to the investment industry of understanding who's on that path to being, future fit or future proof, and who's not. So I think that's a big trend we're looking at. We are seeing companies in this sector trying to understand and get closer to that customer to really understand, I guess, the trends themselves, and how they can best position.
It's a good point, actually, and something we're working on in terms of looking at those companies that are positioned for the future, and it sort of ties into the sort of social license to operate as well as the kind of the sort of general greenness of how they operate. We launched a green economy mark, which is a classification for companies who are delivering green products and services and goods. That's based upon a taxonomy that FTSE Russell developed, looking at 133 micro sectors, and it includes mining of things like rare earth metals and those commodities that are part of the solutions that we need. Now, at the moment, although for all those companies that are listed on our market, we capture those revenues, and for those with more than 50% of revenues from those activities, we award them a green economy mark to make them more visible. We don't currently allow that for miners. And the reason for that is the potential, in order to make sure that this was a relatively new classification, and we want to make sure that the value is maintained and the reputation of that mark for solid companies delivering solutions is there. But actually, the reason that we don't allow miners currently to have it is because of the potential downsides in terms of the way that they operate, the countries in which they operate, and the fact that a lot of the information that's needed is not yet fully disclosed. So I would love to see a point where we can start including miners within that classification as well. So we're capturing the revenues they're generating from these commodities, but actually allowing them to be visible on the market as part of the solution, along with those who are then using those goods and services further down the value chain.
And that's presumably, do the energy and big oil groups, they're excluded as well from that kite mark, are they?
They're not it's about where you're generating your revenue from. So if you're generating, if you're generating, an oil company would have some but very few green revenues. Those that, if carbon capture and storage, for example, as technology came into major use, and you could account for that in a meaningful way, then over time you could see that moving into place. But in reality, this is about companies that are providing, generating, producing products and services as part of the solution. So I guess an oil company in that context is unlikely to qualify because that's not part of the solution. It's the opposite. But a miner could, as they move their portfolio towards those commodities that are used as part of the solutions that we need.
Brilliant, thank you, Adrian. Okay, we've touched now on the way in which investors should be able to get, or might be able to get, more comfort. Adam, if I can come to you, I mean, we've seen BlackRock, the world's largest money manager, be very vocal earlier this year, asking for a global framework for mining companies to report their ESG initiatives. How do you see the pathway going forward in terms of one framework? Do you think that's possible with this sector?
I think there's been a number of asset owners that have been making that call for quite some time, so it's good to hear BlackRock also adding their voice to that perspective. My sense is that you have seen a number of issues that have really challenged institutional long-term investors around the sector. Going back to previous points from other panelists, we all value this sector. It's hugely important. It's part of the low carbon transition. It's producing essential minerals, metals, and it needs to succeed. And then yet there's issues like the Brumadinho tailings dam disaster that calls into question a risk around waste and whether we as investors are understood it. You've had similar challenges, obviously, in relationship to Indigenous communities, and there's a raft of other questions, be that the automation transition. What's the impact going to be on many companies operating with labour-intensive operations? And so these issues are sort of sector-wide systemic challenges, and as investors, we need to understand them, and we need to really have a sort of independent set of criteria that we can apply to the sector, that the sector can have confidence in, and that can actually verify to the site level of individual companies, because I think you need to understand at that level, as well as the sort of the company-wide objectives and how that translates into individual sites. So I think what you've seen with tailings dam is a sort of prototype of where you've developed a standard where one hasn't existed. started. That's worked in collaboration with ICMM, with the UN, with the Principles of Responsible Investment. The Swedish pension funds and ourselves at the Church of England have played a role in developing that standard. Other aspects, other issues, you have already existing standards. And then we're in the process of establishing an independent international institute with the UN that will provide independent verification of the application of that tailing standard. Now, the potential is that you can see that rolled out across a series of issues where there is one standard, one independent verification, something that is done credibly with the confidence of industry, communities, and the investors, the insurers, the banks. And I think that will enable a consolidation and a way for these issues to be addressed sector-wide and really see an evolution of those standards over time to really raise the sector up and ensure that you're not equally just penalising those few companies at the top that are sort of applying these, but these can be driven down with support structures to the small and medium operators that Amanda correctly referred to at a different stage of their journey. So my sense is that that's what the sort of the long-term institutional investors need to work collectively towards. There are a group of asset owners that are discussing how to bring that to fruition, and obviously the steps we've made with tailings dams offers a route to do that. But it does need to be independent, it does need to be transparent, and it does need to be at site level. And I think there's a number of companies that are already operating to many of these standards, and I think there's a huge amount of good practice and knowledge sharing. One issue that really does concern me, though, is automation. And I think there's been a massive correct focus on climate in the sector, but do we really understand the impact of that on the sector, on the labour force across it, and the potential for sort of social strife that can come if we don't have a pathway for the sector to address that in a way that's acceptable with the communities they're operating in. Now, I think you can get there, and I think we've all got a role to play in helping shape that landscape.
And just touch, sorry, Amanda, go on.
Actually, it's a bit of a, I'm going a little off piece, but I'm curious about what you said. We all, I think, agree that global international standards and a way of enforcing them are essential. But the question is, who takes the lead? Do you think it should be the ICMM? Or is there another obvious candidate? Because my biggest issue, and I think the real issue for why these standards haven't been put in place across the industry, is nobody knows exactly who should lead the charge. And the Church of England, alongside the ICMM, did an amazing job with tailings, but it's a much bigger issue than that.
No, absolutely right. And I think that clearly it's good where you have industry initiatives that can standardise good practice, but I'm conscious that ICMM is very much a limited membership with the larger operators. And so is that the vehicle? Maybe not. I think probably what you're going to need to see is the investment community, the banks, the insurers working together with industry, but very much not just working with the largest, to ensure that there's a clarity and understanding of the standards that we expect as the ones that provide the capital, the insurance, the finance into the sector, and actually developing, I feel, a model that can be based upon what we're working on in tailings. So I recognise it's absolutely beyond tailings, but I think there's a raft of issues that you could see an expansion in some kind of independent institute that's able to provide clarity, provide support to companies, and equally provide the independent verification that companies are adhering to those standards that gives investors, banks, insurers the confidence that companies are doing what they say they're doing. And I think that potentially is where we need to go. So I think we're at a point where that discussion needs to be very much alive with the industry. It does need to carry the confidence, and not just of the largest, but also we've got to be sure that countries and communities have confidence in that too. So I think that kind of configuration is possible, but it's something that we're looking to explore at the moment.
And in the absence of a global framework, Andy, we're seeing CEOs of mining companies and others in other sectors complain that the ESG rating agencies are producing different results, in some cases, radically different results on their disclosures. How do you and your team navigate through that when you're advising your pension fund clients?
It's a question we often get asked from companies is, which reporting frameworks do you look at? Which data providers do you look at? And always happy to answer that question. But I also give a bit of a warning, I guess, in relation to that we yes, we use those. We use it as a shortcut to, I guess, understanding a company and its activities and performance. But really, ultimately, it's much more that we need to do, I think, to really understand the proper picture. And we spend a lot of time reading company reporting beyond just what the data providers give. But we absolutely believe in the value and importance of engagement. And I think this is where we get most insight really from the company in terms of what's happening in practice beyond the reporting, when we talk to a board or management and really hear from them about how they're talking about ESG and ESG performance and the future of the company. And I think that's where we kind of get a huge amount of value through that process. And I think, to touch on points already raised, I mean, we do also try to engage and talk with not just the company, but its broader stakeholders. So it's not just its employees, but also the affected communities, union groups, civil society organisations, and that helps us build a picture of a company's ESG performance. So I think, you know, data providers are useful. You know, I'm always concerned if you know, a company's strategy or its reporting is targeted primarily at getting good ratings or getting good assessments under those data providers. It's certainly much more. And I think from that point, I mean, yes, ultimately, I think moving towards a common framework for reporting is useful, but you know, that can't stop us in the meantime of really understanding and moving forward on many of these issues. So let's engage, let's discuss, and let's just try and understand beyond the data and numbers.
Great insight, thank you, Andy. Adrian, if I can come to you, for a long time we've seen various commentators in the market talk about how companies with better ESG ratings actually receive better returns, and Fidelity came out with a report this year saying that was the case for 2020. What are the LSE going about and your indexing to showcase that for companies and investors as a tool, I suppose?
Well, I think there's two ways we're looking at it, reflecting different parts of the business. So as a group, obviously there's the capital markets part of our group in which the London Stock Exchange as an institution sits. But there's also our information services division, which is FTSE Russell, servicing investors with information, ESG and other data and creating benchmarks. So FTSE Russell are constantly working with investors to help them utilize the data and structure it in a way that allows them to adjust their portfolios, and where those, where we see different levels of performance from companies that are managing different aspects of ESG better, then we can highlight that in terms of sort of sharing what best practice looks like and showing the benefits of that. From a stock exchange perspective, we're starting to look at how we can help investors understand that, issuers understand that better. So, for example, with the Green Economy Mark, we've been actually tracking the performance of that group of companies. And now, as I mentioned, that doesn't include miners at the moment, but we've seen significant outperformance of those companies over the last few years, as we've seen the kind of focus on environmental products and services from investors increase, and that's been really interesting to be able to showcase why the opportunities, as well as managing the risk, is something that companies should be focusing on and disclosing data about. We're increasingly also looking at helping them understand where they can benefit from that level of better engagement. So again, the ESG disclosure score tool is really to help them understand that this is about running your business effectively. So this isn't just about disclosing data for its own sake. It's about showing investors how you are managing your business and why that is superior to your peer group, and why that gives you an opportunity to create longer term value. So again, the dialogue we're having with issuers is really to help, not just sort of help them disclose better, but understand the benefits of disclosure. Because ultimately what we want, in the same way that investors want, we want strong companies on our markets. We want the liquidity that brings to our market, because investors have confidence in companies that are listed in London, because from our perspective, we want them to be delivering that better. So that's one aspect. And the other is to the point you mentioned earlier, helping them understand how rating agency works. So there is a discrepancy in different methodologies for ESG ratings. And issuers, as you say, are often quite confused by why they would get a different rating across different agencies. So to help them understand the methodologies that lie behind that is really helpful. So just a very simple example is that FTSE Russell, when it gathers data, it's publicly disclosed data. If an issuer doesn't disclose on a particular data point, they get a 0 in score for that particular point, because there's no way of knowing what's good or bad, and it's an incentive to disclose information. MSCI, and this is not a criticism, it's just a different way of looking at it, they will give an average score for that data point, because for the same logic, they can't say whether it's good or bad. Now that can throw up different scores. I don't think that's necessarily a bad thing, and as I say, investors will use the data in whatever way they see fit, but it helps for issuers to understand those different methodologies, so that they can adjust the way that they report it accordingly and position themselves best. So really that's the way we're sort of looking at it, helping them understand from the experience we have in FTSE Russell how investors are using data, what that means for the way they should disclose, but also in practical terms, what they should be doing, not just disclosing, to reflect changes in investor appetite.
Thanks very much, Adrian. I just want to turn our attention to the next wave of money coming from millennials and Generation Z, and how well documented it is that ESG is front and center of their minds when they make investment decisions. How do we think the mining sector is adapting to this? And we've talked about future-proofing. Amanda, if I may come to you, do you think the miners are going to be able to cater for this new investor group?
I do. I think once again, there's a bit of a communications issue around the whole subject, that millennials, and frankly, even my generation, slightly above millennial, we all care about ESG. We all want to live in a cleaner, kinder, more sustainable world. It's just a fact. But the question is, how do you practically do that? It's great to write lots of emails and blogs and talk about ESG on a computer that was built from mines and metals from all over the world, that may or may not have been built to what we now consider sustainable standards. I think that there needs to be a bridging of that gap. And I completely agree with Adam when he says that we're getting there. We're getting to a global standard. We need to adapt the expectations into a practical reality of how they can be met within a mining framework. And once we have that, the miners can and will adapt. But we're now in that sort of limbo area where investor expectations, which are good expectations and realistic, and they're a great challenge, and they're a great place, they're a great goal to get to, as it were. But we have to figure out practically how we get there, and a reasonable path for getting there. Because I do actually believe that millennials can and are willing to pay more for sustainable products and a sustainable lifestyle. They think it's important, and they are willing to put their money behind it. But what is different is, can they live without it? Can they live without a computer with batteries with cobalt in it? I don't think so. There has to be a medium ground. We have to find a way, a realistic, practical pathway to merge their expectations with what happens on the ground. And I think we're in that area right now. We're in that place where we're trying to figure it out. Because of a lack of a global standard or framework that specifically refers to mining, we've developed our own in-house. And I think a lot of companies are, but it would be much better if there were a global standard.
Thank you. Adam, what's your view on that in terms of, Amanda talked about millennials.
I don't think I qualify as one with a bald head, but that I have. But in terms of, I mean, look, I think there's different aspects to this. I completely agree with what Amanda said, which is terribly boring for a discussion. But equally, I think if you, again, I go back to the sort of what's our duty as a pension fund? Who are we there to serve? People that are saving for pension funds, we're going to be around for decades to come as a pension fund. We're absolutely minded with the people that we are seeking to serve, how they wish their funds to be managed over that time frame that their pensions built up, and that it's not in conflict with their respective values. So we go to efforts to try and sort of bring those two things together, and the world in which they're going to retire into isn't ravaged by the extremes caused by our investments, investing in ways that sort of contrary to those values. So I think there's that one level of those that are coming into pension funds. And I don't think there's quite the appreciation of the role that pension funds can play by those that are invested in them, particularly in the early stages of the career. I think there's a growing awareness, but nowhere near where it should be, because pension funds are hugely influential if they collaborate. And if you can establish the 10 trillion, 30, 50 trillion partnerships across the investment world, then I think you can really drive systemic change. And I think if more people appreciated, understood that, then I think the pressure on trustees to ensure that pension funds are playing their role much more actively would be far greater. But I think that's coming. I think the other challenge for the sector, and one that I sort of feel again is a sort of sector-wide one, is the sort of pipeline of the brightest and the best that need to come into it, and are they going to want to work in the sector? And I think there's a misrepresentation or misunderstanding to some extent portrayed by some of the mistakes of the sector where it's got it wrong, which get the mass coverage, and that really undoes a lot of the good that's been built up by companies around having a good career as an engineer in these companies. And I think we need a much more concerted effort across mining and ensuring that you've got the brightest and the best coming in, wanting a career. I'd love my daughter to work as an engineer in the mining sector. And I just think that that's part of the challenge the sector still hasn't really grappled with. You see some very good examples in individual companies, but how does that get addressed? And then I suspect the other interaction is the workforces that the companies are going to have of the future. Actually, are you going to be providing potentially that labour in many countries where they are a key employer in local communities? And if you have automation coming through, what's the impact of that going to be on the employment environment in areas where actually the mining company is as important as the state, if not more important? And there you could see a real sort of conflict between communities that are seeking the jobs and actually not actually having access to them, where they perhaps perceive that there should be, and yet the resource is still being mined and the profit still being made. And unless they've got a stake in that, you're going to see the potential for real conflict. So again, I think that's another issue where that sort of challenge has got to be addressed. So those three areas, both in terms of the beneficiaries bringing money into this environment, those going to work in the sort of the top end in terms of the highest skills, and equally the rest of the workforce. I think there's three areas there that really need some reflection. And on tailings dams, for example, we've got a new standard, and there's clearly not the pipeline of engineers that are needed to meet the demand of that new standard. And so we need to rapidly build up at scale. And yet I see examples of colleges closing courses on engineering in mining. That for me is a real challenge that the sector's got to grapple with sector-wide, because that's in all companies' interests to address those kind of issues.
Well, we're at the end of our discussion, but I think that the closing remarks are that everyone here agrees that the mining sector has a vital role to play for decades to come as the world moves to energy transition and a greener economy for all, with the vital minerals that it can bring. And it's been fascinating to hear everyone's willingness for that sector to succeed as it continues its increase in disclosures. And a point of partnership has been mentioned by several of you. So Amanda, Adam, Andy and Adrian, thank you very much for your time. You've been very generous with it. And that concludes our ESG panel.
Thank you so much.
Pleasure. Thank you.